Hey there, everybody. Happy weekend. This is Bob from Trade Genius. Got my good friend Phil here with me. Everybody wants a great sale, and the world's going to get the biggest half off sale ever. Stay tuned.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening. Okay, Phil, we've been touching on this for a while now, but now we're crossing some Rubicons, and the data from a couple different directions spell the same doom message. You want to share the details with them?
Yeah, let's just dive right into the chart here. So this is the United States yield curve between the 10-year and the 3-month. We've shown you guys the 10-year and the 2-month before. Similar story. But the interesting thing here with the 10-year and the 3-month Treasury yield spread is that we're negative. I think everybody pretty much knows that by now. The length of time that we've been negative, though, is an outlier. And what I mean by that is we've spent over 500 days now. This chart is courtesy of Game of Trades. You can check them out on Twitter, but we're at 511 days now, Bob. The last 2 times we exceeded 500 days was in 1974 and 1929. 1929, probably everybody knows, right? Great Depression stuff. But both of those times we were down 50% in the coming months in the market. And this is why it kind of goes into what we were saying. Enjoy the last rally, because what comes after can be pretty painful, Bob.
Yeah, and I have a theory on this because the Fed has been trying so hard to break inflation. They actually break the entire economic system when they go this long, and you can't just easily ease your way out of it because you actually create some structural breaks.
Right.
And people are not in a financial condition to borrow again. It's really, really sobering news that people really, really need to pay attention to. We are getting gifts. Okay. And if you don't take advantage of these gifts to fortify your personal balance sheet and position yourself for the swing the other way, you guys are in a world of hurt.
Right.
But Phil, you have another chart here. Do you want me to do it, or do you want to go do it?
Yeah, let's just bring it up. Consumer sentiment, right? Huge miss. We talked about that yesterday, but sometimes it's good to overlay it on an S&P 500 chart. And you guys can see that not only is sentiment, way down there from where basically we were trading from a lower standpoint, it also is the rate of change. Remember, we talk about rate of change or how quickly things move up or down with economic indicators. And we got a rate of change here down that, for me, signals that we're going to see some follow through in the market. Now, it doesn't happen right away. As you guys can see, consumer sentiment can fall off a cliff. And that's something we saw going into the end of, I believe it was 2021 there on the chart, Bob. Then we stalled out in the market, and the market had a pretty harsh correction. It's deja vu all over again here.
Yeah, and when you get these big misses like that, especially when they didn't predict them, I think people are starting to throw their hands up and people are starting to give up, and companies are going to start to get worried. And I think what we're going to see here over the next, 3 to 6 months is more and more sectors start to retrench.
Right.
And at some point, they're just not going to be able to keep the balls in the air. But I do agree with you, Phil, and actually maybe next week we'll do a couple videos. There's some sectors that are going to blow sky high here before they get crushed, because we're already starting to see some really divergent patterns that are bullish in some sectors that have been struggling here a little bit, that can really move the market fast. And I think that's going to be our opportunity here to basically bring the hay into the barn here before winter comes.
Yeah, and I think too, we talked about and have shown graphs that the consumer is really getting squeezed now. And I think that might be why too the Fed, they came out recently, and of course their messages have been varying across the board, but the speaking engagements have been nonstop with the Fed governors. But it seems like they're back on harping on inflation again. I mean, I think that's because the consumer here is stalling out, and now inflation hasn't come down quick enough, and now it's hammering on the consumer, and so they're almost threatening another rate hike, even though you and I both know that's probably not going to happen, because the next thing they're going to have to do is they're going to have to get defensive, and they're going to have to start cutting because things are going to start to get bad. But the point I wanted to make was that, when you have companies like Disney telling you that they're worried about profitability down the road. That's something we have not heard in years. And that's probably because the economists that they employ are telling them like, hey, these parks are going to start slowing down here as we get into the rest of the year. And that's just something that even in COVID, we never heard from them, right? They knew that these people staying home were probably going to show up to the parks. But now I think they see the consumers overextended. Personal interest payments are at all-time highs, skyrocketing, blowing. Any readings that we've had elevated for personal interest payments are just getting blown out of the water with the current readings. So everyone's completely, well, for most consumers anyway, they're completely maxed out. And we just have this weird divide where most people are in that situation. The upper, 1 to 5% are doing okay. But at some point, this is going to roll over and it's going to affect everyone.
Yeah, people are down to only being able to pay for consumables because they don't have the lines of credit now to float a $5,000 vacation or even a couple $1,000 car maintenance thing. It's going to get pretty scary out there, Phil. So guys, buckle up. It's going to be a wild, wild, wild ride coming up, and it's going to come out of the blue. And you're just going to see one day the analysts are just going to turn on a dime when those guys are all positioned short, and you're going to be left holding the bag. So if you're passive investing right now and you have a financial manager managing your stuff, you need to start having some hard conversations with them about the data you're seeing here and make them squirm a little bit, because most of these guys are only working off of age and risk tolerance programs to keep themselves from getting sued. And so you're going to need to pierce that and say, hey, what's your plan for me if this happens, especially if you're 50 or older. Remember, during the Great Depression, we didn't get back to the same price. I think, was it 18 years or before prices got back to where it was before. I think it was after the war as well.
Yeah. So guys, let us know your thoughts in the comments below. Otherwise, please hit like and subscribe. That really helps out our channel. Check out our stuff over at tradegenius.co if you want help navigating these markets, because they are going to be a challenge going forward from here into the end of the year. Head over there and check out our specials. You can join us in the Discord room so we can help you navigate these markets. All right, guys, thanks for watching. Thanks, Bob. We'll see you guys in the next video. Take care.
Trade Genius.